Hello, everyone. Today we are going to interview in casting strategies Adam Butler. One of the opportunities the interview format is giving us while having US investors allows us to connect with different investors and different possibilities. Corey of Steen gave us the contact of Adam Butler, so I'm really thankful to both Corey and Adam, and today we are interviewing Adam Butler. I'm switching to English so that you can understand it. So let's dive into the interview.
So Adam has 15 years of experience in investment management, including 12 years as a portfolio manager. He's primarily responsible for research efforts related to the management of investment portfolios at Resolve Asset Management. He's the lead author on several public research white papers and the book Adaptive Asset Allocation, Dynamic Global Portfolios to Profit in Good Times and Bad Times. Adam worked as a portfolio manager at Richardson GMP and Macquarie Private Wealth and as an investment advisor at BMO Nesbitt Barnes. Subsequently, Adam, along with his partners, Mike and Rodrigo, continue to evolve their quantitatively focused investment methodology by fitting in machine learning into their pipeline. So, hello, Adam. How's it going? Everything okay here?
Everything's great. Yeah, I'm coming at you from Cayman Islands, where we haven't had a live COVID case in several months outside of quarantine. So very thankful for how well the government here has managed things, and hopeful that we'll be able to keep things under control until maybe they start disseminating vaccines early next year or mid next year. So very interesting times, just like the Chinese curse.
Yeah, absolutely. I think we have, in this case, all of us are waiting for this idea of normalizing the situation again, coming back to normal. We hope. Totally.
Exactly.
So I have the first question that I have is tell us a little bit about your background and how you got into the financial markets at all.
I started out with an investment competition in university. I actually was in the psychology program, and I was for some reason interested in stocks, and there was a stock trading competition. I ended up winning it by just mass trading out of the money tech options. It was 1996. And then I was featured in a couple of local papers, and then I entered the next one, and I came third in that one. And this was like a national competition. And so a few of the larger papers picked it up, and then I kind of parlayed that into some interviews on the trading floor at one of the major Canadian banks, and landed a job as a stock trader, junior stock trader on that trading floor, and traded there for a couple of years, and learned a hard lesson about taking on too much concentration risk. And then I left the business for a little while. I went and got my CFA, and I actually went and got a diploma in computer programming, and came back about 5 years later with the freshly minted CFA, and went on to become a portfolio manager primarily for private wealth clients. And over the course of time, developed some, I think, different views on how to manage portfolios than were commonly espoused, and founded an investment company on those principles in 2015.
Totally quantitative. Sorry. Go ahead.
Could you tell us, Adam, what is Resolve Asset Management? Could you summarize which is the job that you are doing in your company today, and which is the approach of your company to the market, and what are you offering to the clients?
So I started out, when I was a wealth advisor, I started out primarily as a stock picker, informed by global macro themes. And this was a time when the major theme was the rise of the middle class in Brazil, Russia, India, China, the BRICS, and had a really great stretch trading for my wealth clients from sort of 2006 till the middle of 2008. And then while I was on the right side of the US banking short trade and the real estate collapse, I was on the wrong side of the emerging markets commodity trade and ended up having a very difficult time in 2008. And it caused me to rethink my entire approach to markets. And about the same time, I started reading the works of Nassim Taleb and Philip Tetlock and James Montier and the behavioral finance literature. And I was particularly struck by things like the narrative fallacy, as Nassim Taleb describes it, and by the book Expert Political Judgment by Philip Tetlock. Are you guys familiar with that?
Yeah.
Mm-hmm.
Yeah.
Yep.
So what struck me was that he'd spent the better part of 2 decades interviewing 200 experts in a wide variety of fields and trying to get a sense for how well experts are able to forecast in ambiguous or complex domains. And with about 18,000 observations across a wide variety of different domain specificities, all of these experts, he aggregated the results and derived a variety of early conclusions, right? One of them was that no expert was able to deliver forecasts with better calibration than just random guessing. Even, groups or ensembles of experts, especially as he went on in his book, Super Forecasters, to show ensembles of forecasters with certain group characteristics can sometimes do a little bit better than chance, but it's unusual to get a group together with those characteristics and with the right incentives. So in general, he just sort of, I was persuaded by his research that the whole idea of trying to forecast markets as a way to generate alpha was just not a prudent direction. And alongside his study of expert forecasts, he ran some simple statistical methods like regression, for example, and found that some of these really simple statistical methods were able to generate forecasts with much better calibration than any of the individual experts or groups of experts, and was able to generate forecasts with better than random accuracy. And so that sort of motivated, around the same time, I was starting to read some papers on systematic strategies, and it sort of motivated a complete reorientation of my thinking in this, in how to approach markets. And so Resolve really is an outcrop of that, and a realization of the view that we should take a systematic approach using statistical methods and fairly simple fundamental models of asset pricing to inform broad global asset allocation. And that moved into a multi-year exploration of how to maximally diversify portfolios across diverse asset universes and make them maximally resilient to different types of economic regimes defined by different types of growth and inflation shocks. And so that led to sort of a core portfolio informed by global risk parity. And at the same time, we were exploring some systematic factor style strategies, primarily trend following in the beginning. And then as we became a little bit more educated and sophisticated, we also deployed strategies that were informed by such things as carry and seasonality and higher orders, higher moments of the return distribution, that sort of thing. But all of them informed by this idea of maximizing diversity and thinking systematically about the problem. So that's what Resolve does today.
Okay, this is interesting because we love also this quantitative approach. And my next question is about your journey in adopting machine learning into your approach. Where have you changed your mind? Because in our case, we love this platform, AI platform, and actually we bought a private company in Austin, in United States, AI company, and now I'm just I want to dig a little bit more into this matter. So where have you changed your mind?
We started out sourcing most of our systematic strategies from the academic literature, right? Obviously, there's a long history of literature and empirical finance that gets behind the trend premium, for example, and the carry premium. And then, more obscure papers and some of our own research really found a lot of interesting dimensions in seasonality data and in higher order moments of the return distribution for forecasting purposes. But we were using those with the same specification broadly. We ensemble around them, and we had some advanced portfolio optimization methods that we were bringing to the table. But largely, the signals were informed by what was best practice in the academic literature. And over time, as we observed the performance of some of these really large funds and the underlying factors that are inside some of these big funds, we began to see that these really big, widely adopted, peer-reviewed academic factor strategies were decaying. And in fact, they were decaying at an accelerating rate. And we published a research piece, sort of a thematic piece, a few months ago on what we call the post-factor world, which describes these factor strategies along the same dimensions as a typical technology adoption curve, where, before there's any publication about these anomalies, the anomalies are strong because you've got a class of investors that is avoiding securities with certain characteristics, or they're expressing other non-wealth maximizing preferences that lead to anomalous mispricings of certain classes of securities. So, imagine you've got $1 billion worth of investor assets that are avoiding securities that have a negative trend in earnings over the last 3 years, right? And so they are selling out of these securities at a disproportional rate. And so these securities are trading at a discount. And you've got other actors who want to buy these securities because they're trading cheap. So they're chasing after value stocks. And if you buy these securities that other investors don't want to own, they're mispriced to the downside, and therefore you have an expectation of earning a high premium. So let's say there's, just to keep the math simple, $1 billion of investors that are avoiding these securities. A paper is published that identifies this opportunity. And then you've got $1 billion of investors who deploy capital to arbitrage this opportunity. Well, if you've got $1 billion of investors that are avoiding it and another $1 billion that are chasing in, well, then you'd expect the premium to now be zero. Well, what if that's now $2 billion of arbitrage investors that are chasing in? Well, wouldn't you expect those securities now to be mispriced to the upside and therefore the return premium to be negative? And so there's this whole idea of there are premia, but publication changes the nature of the premium because it informs potential arbitrageurs of an opportunity, and therefore they deploy capital in that direction. And that eventually, as a first stage, eliminates the premium. And as a second stage, if too many investors crowd in, it inverts the sign of the premium. And in fact, if you examine the performance of a lot of these really big factor funds or alt-style premia funds over the last 3 or 5 years, we're seeing exactly what happens when when the sign of these premia invert. You've got the biggest gold standard alt-style premia since 2018 with Sharpe ratios of like -1 and -1.5. It's almost like a straight line down. And so as we came to terms with this about 1.5 years ago, we began to explore ways to identify systematic anomalies that had not been previously published in the literature. And so that was really what motivated our move into the domain of statistical learning and pursuing complex relationships rather than simple linear relationships in the data, and then also trying to zero in on relationships that are specific to individual markets rather than trying to identify relationships that are common in the cross-section of markets. So just really trying to avoid crowded trades and zero in on the most persistent and economically significant trades that have just not been generally identified by the broad academic community.
I like what you are saying, because you are saying one thing that I have not listened to much. That is the impact of literature in the movement of the markets. The impact of research, literature, and papers in how the market is performing. It's is kind of thing of behavioral finance, but in the line of how the literature is affecting our research, is affecting the market, and I like it. And with all this idea that is a very clever idea, about how the markets are performing, how do you place the machine learning to work in the market? Are you placing the machine learning to look for alpha or to make a diversifying portfolio? How do you apply this technology?
That's a good question, actually, because you can obviously apply it in a number of different domains, and the approach that we've taken does give us conditional expected returns. So given a feature, what are the expected returns under different conditions for that feature? But it also obviously gives us, really, volatility is just expected mean of the squared returns, right? So you can use it to also estimate volatility conditionally, right? So imagine you've got a historical realized volatility measure, and you've got a 1 month, 3 month, and 6 month implied volatility measure. And so you're going to take those 4 features and use them to forecast volatility on a security over the next 1 week or 1 month or 1 day, right? So obviously you can forecast returns, or you can forecast volatility. There are obviously different types of learning you can do to also forecast covariances. We haven't really done a lot of work in that space. The reality is that just historical vol is pretty darn explanatory, or a pretty darn good estimator for forecasting vol. And so a lot of the other features are kind of around the edges. It's kind of the same for correlations. And when you're forming a portfolio, we know that errors and estimates of volatility and correlations at the portfolio level don't really have that large an impact. As long as you sort of have the order right, then you're in pretty good shape for portfolio formation. So the noisiest and most impactful aspect is the estimate of means. And so that's where we've really focused a majority of our time. And on the machine learning front, we certainly haven't tried a machine learning approach that throws every conceivable feature and convolution of those features into an almost infinitely large matrix and finding relationships. Just the dimensionality of the problem is too large, and so you've got this problem of scarcity. So I think you've got machine learning is, in my experience anyways, extremely helpful, but it does require an experienced and skillful practitioner to identify features that are likely to be explanatory. And you don't know maybe the exact relation or the nature of the relationship. You don't know the appropriate level of complexity or the specific function, but you know that this type of feature has a reason to explain or forecast returns for given markets. And then you're just learning what those relationships look like. And then, so, you've got this sort of feature curation, you've got this convolution layer. How do we want to transform those features in meaningful ways? And then you've got this sort of statistical learning process that's really just learning the relationships. And then, of course, at the end of it, you've got to identify, now that you've got all these features and all these relationships for all these markets, which ones generalize most effectively at a sample. And that's so there's at least 3 and probably multiple other layers to the process that requires some experimentation and requires or benefits tremendously from experience from a practitioner. So it really is a man-machine partnership more than it is just throwing a bunch of non-contextual data in a machine learning in a black box and expecting it to print money at the other side.
Yeah, this idea of combining both human in machines, I think, is the key point. Also, in our case, also we have developed some pipelines working with machine learning, and we have made it the same point. This idea of trying to combine both ideas. As I gather, the portfolio construction maybe it's a point where we should focus in our case at least, and it's true that the alpha generation is not that easy, but I mean the directly approach in order to look for alpha generation is kind of complicated, but altogether it's incredible. I think it's an incredible opportunity that we people that like statistics, it's awesome. What is can you elaborate? This is kind of my last question in this in the show is that can you explain a little bit more, elaborate what are for you the bespoke factors that you mentioned over there in some pieces?
That's a part of our post-factor world concept. And so the idea is that, factors are nothing but systematic anomalies that persist through time. What distinguishes typical academic factors from our bespoke factors is primarily that they are published by authors with high status that get attention in high status journals and therefore ride into the Overton window for the big institutions that are able to convince their investment committees and boards that they should make an allocation to these types of factors, right? So it's that peer adoption, academic publication halo effect for traditional factor strategies that we actively seek to avoid. And we do that by, like I said, first of all, avoiding factors or seeking factors based on how they perform in the cross section. In other words, across all markets together. We're not looking for factors that explain returns for across all different equity indices, all different bond indices, all different commodities, that sort of thing. Like if you think about trend following as a general systematic factor strategy, then you're applying typically the same trend signal or the same group or ensemble of trend signals across all of your markets. And it's typically either a binary relationship. So if it's above a certain moving average or if it has positive returns, then you're gonna have a positive exposure. Usually one unit of risk budget will go into that market. If it's below a moving average or has negative returns, it has one negative unit of risk budget that goes into that market. So it's a very simple relationship, right? It's +1, -1 risk budget or unit of risk budget. Or maybe it's a linear function. The stronger the trend, the larger the risk budget allocation, right? So they tend to be very simple, either linear or binary or sort type relationship structures. Yep. And we're looking for relationship structures that are typically nonlinear, more complex, and individual to each market. Different types of trend or mean reversionary dynamics may work well for treasury bonds or gold or S&P, and they may not look at all like one another. And you may be in fact able to use trend information or carry information from the treasury market to inform S&P returns over the next few days or weeks, or gold returns, or maybe they'll use the volatility term structure to inform treasury or gold or oil returns, et cetera, right? So we're zeroing in on the individual relationships, and we're finding the optimal level of complexity to balance off the bias variance trade-off for each combination of feature and market. And I think we've got some pretty novel thinking on how to achieve that optimal balance and gain confidence in the sustainability of those relationships.
Yeah, interesting. And actually, it's just out of curiosity, because the things that you are talking about, especially leans on the trend following idea and momentum idea. So is this the place where you focus your job?
Good question. We didn't really cover this, but we primarily trade futures. We do have some separately managed accounts that apply some strategies using ETFs, but primarily we are deploying these more sophisticated strategies using futures. And so it's like I said, it's trend. All different types of trend specifications but it doesn't need to be in the direction of trend. It could be, you're using 20-day trend as a feature, but it could be that for gold, that feature is inverted. And in fact, you're better off using it as a mean reverting type of signal, or it's more likely to be some kind of weird nonlinear relationship.
Gotcha.
And carry and seasonality and volatility term structure and correlation term structure across multiple asset universes. But we're expressing them in the global macro space. So on futures, yes.
Okay. So Loren, something else to say? Lorenzo is not here. Something has happened with him.
We may have lost him.
Yeah, we have lost him. Okay, so actually, we were gonna close this interview here. So Adam, it's been really a big pleasure to have you on on the show. And actually, this idea of talking about AI in the systematic field, I think is something that we have to keep going and digging in. So very likely we will reach you again, because this may be interesting, and also because, since we are doing it also, I think it's a thing we have to keep talking about it. Maybe Lorenzo has something else to say, or we just leave it here.
No, I just have to say thank you. And I have to say that I like a lot these ideas of behavioral finance that you are talking. And I'm going to go deeply to them to understand more and more what you are doing and saying. And I like it a lot, this literature affecting the market, and I'm going to go deeply to this. So thank you very much for these clever ideas.
My pleasure. Thanks for all the great questions.
Okay. So
thank you very much, Adam, for tuning in, for participating in our show. If you liked it, please subscribe to our channel, like it, and share it on your social network. Thank you. See you next time.